$5,000 wasn't supposed to happen like this. Gold didn't grind higher over years. It didn't inch past resistance. It exploded straight through $5,000 an ounce, faster than nearly every major forecast said was possible. And here's the contradiction. This is happening while leaders insist the system is stable, inflation is contained, and nothing fundamental has changed. But the market is telling a very different story. In just 12 months, gold is up 84%. Silver didn't just rally, it went vertical, surging more than 250%. Those numbers are real. Markets are no longer reacting to inflation, they're reacting to fear. And this isn't abstract. This affects you whether you trade metals or not, because when capital moves this fast into assets with no counterparty, it means investors are preparing for something they don't trust institutions to handle. Not later, now. Here's the part most people miss. This move didn't start with a chart. It started with words. Words that quietly signaled the rules protecting global stability may no longer apply. And once you hear who said them and what they actually admitted, this price surge stops looking irrational and starts looking inevitable. The core event isn't just that gold crossed 5,000, it's how quickly the market accepted that number as real. This wasn't a slow debate between buyers and sellers, it was a sudden agreement that old assumptions no longer mattered. Gold shattered a psychological ceiling and entered what traders themselves describe as uncharted territory. When resistance levels stop working, the market believes the game has changed. At the same time, something else was happening in parallel. Global leaders weren't talking about growth or cooperation. They were issuing warnings. The United Nations Secretary General openly stated that the international order is being replaced by what he called the law of the jungle. Those words matter. Markets don't react to poetry, they react to signals. And this was a signal that the systems meant to enforce stability may no longer function. Now notice the pattern. As confidence in diplomacy weakens, capital doesn't wait for confirmation, it moves preemptively. Investors aren't asking whether a crisis will happen, they're asking whether anyone can stop one once it starts. And that reframes everything. So here's the question most coverage avoids. If this isn't a one-off panic, but part of a broader breakdown in global order, what proof pushed markets to move this fast? Here's the first hard proof that this move isn't emotional noise. The shift accelerated the moment geopolitical language crossed a line markets take seriously. The United States president publicly warned, "We have an armada, maybe we won't have to use it," referring to Iran. That wasn't diplomatic ambiguity. That was a direct reference to a massive naval force positioned for potential action. Markets understand what that means. An armada in the Middle East isn't symbolism. It sits next to the energy arteries of the global economy. When oil routes, shipping lanes, and regional stability are suddenly tied to military threats, risk models break. And when models break, money doesn't wait for clarity. It moves to safety. Here's the key detail. That statement wasn't walked back, it wasn't denied, it wasn't softened. Notice what's missing. No reassurance that escalation is off the table, no commitment to de-escalation. Silence filled the gap, and markets hate silence more than bad news. Investors interpreted that silence as permission for volatility, not certainty of war, but certainty of unpredictability. That's enough. Because once traders believe outcomes are no longer controlled, they don't price probabilities, they price survival. And that was only the first flashpoint, because while everyone was watching the Middle East, another signal appeared from a place no one expected, opening a completely different front. This is where the story escalates, because the Middle East threat didn't stay isolated. Almost immediately, pressure appeared in a place markets rarely price for conflict at all. The United States signaled possible deployment of military personnel to Greenland, alongside threats of tariffs against nations opposing American control there. That's not routine policy. That's the militarization of geography. Greenland isn't symbolic. It sits on critical Arctic routes and resource corridors that will define future trade and energy flows. When a major power signals it's willing to use force to secure that terrain, markets read it as precedent, not about Greenland specifically, but about what's now considered acceptable. Here's why that matters. This isn't the first time resource security has triggered global tension. History shows that when access to energy, shipping lanes, or raw materials becomes uncertain, conflict stops being theoretical. But what's different now is speed. These signals are arriving back to back across regions without cooling off periods. Notice how quickly this behavior is becoming normal. Military threats, tariffs, and territorial pressure are being discussed openly, almost casually. Something that once would have shocked markets is now absorbed in real time. And when instability becomes normalized, investors stop trusting that anyone is managing the system. Which raises the next problem. If force and coercion are becoming standard tools, what happens when economic pressure replaces diplomacy entirely? Here's the second proof hit, and it's more disturbing because it targets allies, not adversaries. The United States issued a public ultimatum to Canada, warning that if Ottawa signs a trade deal with Beijing, all Canadian goods entering the US would face an immediate 100% tariff. No negotiations, no delay, instant economic punishment. Now pause on that. Canada isn't a rival state. It's a core trade partner inside one of the most integrated supply chains on Earth. And yet the threat wasn't delivered through diplomats or formal channels. It was broadcast directly on social media, bypassing the mechanisms designed to slow escalation. That detail changes everything. Here's the contradiction markets can't ignore. On one hand, leaders speak about cooperation and stability. On the other, they threaten to collapse entire supply chains with a single post. A 100% tariff would effectively halt trade overnight. Investors are being forced to price in decisions made impulsively, not institutionally. This is where perception flips. Gold isn't rising because of inflation data or earnings forecasts. It's rising because contracts, treaties, and alliances now appear conditional. When rules can be rewritten instantly, trust disappears. And when trust disappears, capital looks for assets that don't rely on promises. And just as this pressure built, something even more alarming emerged beneath the surface. Because while prices were exploding on screens, the physical market began to show signs of something far worse. Now the pressure stacks, fast. While gold grabbed headlines, silver began behaving in a way markets reserve for emergencies. Silver surged roughly 225 to 252% in a single year, blasting past $100 an ounce and pushing toward 110. That doesn't happen in orderly systems. At the same time, analysts flagged something critical. Physical silver inventories tightened sharply. Lease rates spiked. Those are not abstract indicators. They mean traders were scrambling to secure real metal immediately, not paper claims. Reports pointed to acute supply constraints. The market wasn't betting on future demand. It was reacting to present scarcity. Layer another development on top. Industrial demand didn't slow. Solar panels, electronics, and energy systems kept pulling silver out of circulation. No pause, no relief. The market felt squeezed from both sides at once. This is what loss of control looks like. Prices accelerate, inventories vanish, and no single actor can stabilize the system. Each move feeds the next. Fear compounds speed, speed destroys buffers, and that leaves one unavoidable question hanging in the air. What happens if this doesn't slow down? If the pressure keeps building with nowhere left to release it? Now shift this away from charts and into real life, because this doesn't stay on trading screens. It reaches you whether you're watching markets or not. When metals surge like this, it's a signal that the cost of building, powering, and securing everyday systems is rising underneath everything else. Silver is essential for solar panels, electronics, and energy infrastructure. When silver prices explode and inventories tighten, manufacturers don't negotiate. They pay whatever they must. Those costs don't disappear. They move downstream into energy bills, into electronics, into transportation, into jobs. This is how instability becomes personal, not through headlines, but through delays, shortages, and higher costs that arrive quietly. You don't see silver squeeze on a receipt. You see projects postponed. You see prices adjusted. You see systems strained. And notice how little warning most people get. By the time these pressures are visible to consumers, the market has already moved. The decisions were made months earlier in silence while attention was elsewhere. If this feels familiar, like costs rising without a clear explanation, say so in the comments. Because this pattern isn't random. It's the surface effect of something structural underneath the system, and understanding that mechanism is the key to seeing what comes next. Here's the deeper mechanism most coverage misses. This isn't chaos. It's incentives colliding. Falling real yields, expectations of rate cuts, and a softening dollar are acting as fuel for precious metals. The Federal Reserve is boxed in. If it tightens too hard, it risks breaking the system. If it eases, it devalues the currency. Markets believe the choice has already been made. At the same time, geopolitical risk is being amplified by spectacle. Threats are public. Timelines are compressed, decisions appear personal rather than procedural. That changes behavior. Investors don't wait for policy papers, they respond to leverage and fear. And fear is more powerful when it's unpredictable. Add one more layer. Physical scarcity turns financial hedging into a scramble. When metal is hard to source, paper assurances lose credibility. The system quietly shifts from trust-based to possession-based. Not because people want drama, but because incentives demand it. This is why the move feels unsettling. It's rational inside a system that no longer promises stability. And once that switch flips, it doesn't flip back easily. Which brings us to the fork forming directly ahead. From here, the trajectory splits, and neither path is comfortable. One possibility is temporary calm. Rhetoric cools, markets breathe, and prices consolidate at levels that once seemed impossible. Analysts already say this rally is no longer about short-term speculation. Even in calm, the reset remains locked in. 5,000 doesn't vanish, it becomes reference. The second path is acceleration. Geopolitical pressure continues. Trade threats harden. Supply constraints deepen. China's appetite for silver and gold accelerates further, pulling physical metal out of global circulation before Western markets can respond. Reports confirm Chinese demand has surged sharply, not for luxury, but for strategic and industrial survival. Momentum feeds on itself in already tight markets. What matters is that both paths point in the same direction. The old pricing assumptions don't return. Uncertainty doesn't unwind, it embeds. Markets stop asking where prices should be and start asking where protection exists. And here's the unsettling part. The next move isn't waiting on data releases or forecasts. It's waiting on a decision, a post, a deployment, or a breakdown that hasn't happened yet, but is already being priced in. There's one insight that ties this entire story together. Gold didn't rise because the future looks brighter. It rose because the future looks harder to enforce. Institutions meant to stabilize the world are being questioned, bypassed, or weakened in real time. When enforcement disappears, trust follows and money moves first. This isn't a panic spike, it's a recalibration, a market quietly admitting that contracts, alliances, and rules no longer carry the same weight they once did. $5,000 isn't a ceiling reached by speculation, it's a floor set by uncertainty, and that's the loop most people miss. Every time a threat replaces diplomacy, every time scarcity replaces surplus, every time speed replaces process, this recalibration deepens, not loudly, permanently. If you want to understand what this shift means before it shows up in your life in ways you can't ignore, stay here. Follow for the next layer of this story because the next signal won't come from prices. It'll come from power, and by the time it's obvious, the market will already have moved.